So I apologize in advance because my voice will probably sound a little bit different. I'm still recovering from a flu, and my nasal passages are probably all blocked. But that said, I think the show must still carry on, and I've prepared a very simple deck to update you a little bit in terms of the price performance of Alibaba recently, and more importantly, update you a little bit in terms of my most recent portfolio adjustments. So a friend of mine have recently sent me some sort of a mega cap performance review. Palantir is the largest performer at a 49% year-to-date return, and it's not even halfway through February. And you can see coming in at the second place, it's actually Alibaba at 33% year-to-date. So the natural question would then be, are we finally in the clear yet? So I believe the large consensus around investors today, specifically to Baba investors, are that most of them are skeptical. Skeptical in a way where if you actually pull out the price chart of Alibaba over the past 3 years or so, you are being greeted by this range. And Alibaba is essentially trading within this $65 to $110, $120 range. And they've failed to break out again and again and again. And this is, I guess, the fourth time we are trying to break out. So naturally, as animals that always try to identify some sort of a pattern, if you look at this chart, you would probably think that, hey, we are probably going to reject this key resistance level again. So if you zoom into the past 2 weeks, these are the headlines that essentially dominated the Alibaba community. I believe for those of you who have been avid investors and heavily involved in the tech scene, you probably know of the Chinese rival of OpenAI, which is DeepSeek. And in late Jan, Alibaba released an AI model saying or claiming that they did surpass DeepSeek version 3. And subsequently, Alibaba announced a high-profile AI expert hire, which is Stephen Hoy, and he's basically named the vice president of Alibaba. So even after these two developments, Alibaba was basically trading at this range. And it was only until 2 days ago when there were rumors coming out saying that Alibaba has intentions of taking up an equity position or investing into DeepSeek, but they've quickly came out to dismiss the rumors. However, the interesting thing is, despite Alibaba's dismissal, they still managed to close quite significantly above the previous share price. And last but not least, of course, just yesterday, there were news saying that Alibaba might potentially pair up with Apple to develop the AI features for the China's iPhones. So clearly, after yesterday's announcement, nobody came out to reject the claim, which might potentially hint to a real partnership between these two juggernauts. So of course, we are still at a very speculative stage where nothing concrete is being announced. But one thing for sure is that investors are basically trying to front run this event. And if this comes into fruition, I think it's definitely beneficial to both the Apple China business and Alibaba's cloud and AI advancement. And just a side note, Jack Ma has recently made the news again of appearing in one of their headquarters. So you thought only Alibaba is rallying? Think again. Benchmarking it to the Hang Seng Index that is up roughly 11% year to date. Both BYD and Kingsoft is up roughly 36%. And SMIC, the TSMC equivalent of China, is also staging a very, very big comeback. So mainly circling around this semiconductor and AI space. And you can probably say that the Chinese tech sector is 3 years, 4 years late to the game, but better late than never. However, I think a clear distinction here, especially as long-term Alibaba shareholder, is that when Alibaba shares were cheap and valuations were on the low side, the management team was aggressively buying back shares. So despite this recent rally, even until the $110, $120 range, personally speaking, I do still think that they're undervalued, but not as undervalued as compared to the previous $60 to $80 range. A lot of all these AI narratives, they are good to boost up demand for the shares in the short term. But in the longer term, I think our focus should always be on their bottom line earnings, bottom line free cash flow, and how they're able to translate to real dividends or real cash flow for shareholders. And also just to jog your memory a little, in the last few weeks and last few months, headlines around China stocks still remain relatively flat. Titles such as China stocks suffering the worst fall in 27 years over growth concerns, absent stimulus, pain for China stocks will still continue, and Asia's sharp reaction to Trump's tariff are a bad omen for the global economy. If this price action continues to remain strong out into the next quarter, I do believe that prices will drive narrative, and you can see that all these headlines will have a new editor-in-chief coming in to refresh the news headline cycle again. So as headlines continue to change, do you know what else is going to change soon? Moomoo's welcome bundle for new users. So you must celebrate the new year with Moomoo as they're offering Angpao deals worth up to 3,154 Singapore dollars. It's the perfect way to start 2025. So here's the deal. New users to Moomoo can now sign up for an account with my link below, and you'll get 30 days zero commission for the Hong Kong stock market and lifetime commission free in the US market. On top of that, new users can get up to 1 free Tesla share and $20 worth of cash coupon, which is an affiliate exclusive if you use my link below. So for those without $100,000 in capital, to qualify for the highest tier of sign-up rewards, you can deposit at least a cumulative amount of 3,000 Singapore dollars, complete 3-buy trades, and maintain the assets for 30 days. And you'll get $20 in cash coupon plus an additional 0.1 Tesla shares, worth roughly 47 Singapore dollars. So that's $67 worth of rewards in 30 days, 2.2% of a 3,000 capital base. And for those of you who have created a Moomoo account before but have not made your first deposit yet, you are still eligible for this sign-up promotion. So all you have to do to get this special deal is to log into the app, search for a special deposit, and click Go, enter the promo code CK88, and make your first deposit. You'll then be able to enjoy the new user rewards mentioned earlier. Oh, and did I also mention that you can get an interest booster of up to 6.8% per annum for the first 30 days if you park your money with Moomoo Cash Plus. And I heard that this promotion is ending really soon. So for those of you who are still sitting on the fence, don't wait any longer. So this sign-up reward campaign will end on Valentine's Day, 14th of Feb 2025. It's the last call. Sign up link will be in the description below, and thank you Moomoo for sponsoring this video. So given the crazy volatility of China stocks, my positions could be down 20% 1 month ago, and this month I'm up 10%. So I might not have much time left before my position goes into the red. So please indulge me in this video where I will be able to proudly show you my existing portfolio breakdown. So for long-time viewers, you probably would have known that I've held onto some of these Chinese tech names for some time now, and I've been averaging down aggressively, and I have a cost price of roughly around $109 per share, but that's before dividends, and accounting for the 2 rounds of dividends that I've gotten, I think it's closer to 105. But I think that's not the main point here. The main point is, of course, I want to show you that I have a pretty green portfolio. But jokes aside, in the name of transparency, this is the screenshot of one of my bigger accounts on IB, and you can see the breakdown in terms of the portfolio movement and volatility over the past 2+ years or so. And I've only kickstarted this portfolio when I started working full-time in 2023. So in this portfolio, it's roughly a 60-40 split. 60% in China, 40% in US. So that's why you can observe that there's a pretty big correlation when you monitor the pink line, which is tracking the Hang Seng Index. And whenever there's a big rally, the blue line, which is my portfolio, also go through that ebbs and flows. But the interesting thing is, because I do have a 60-40 split, whenever the US market experiences some sort of a correction or pullback, as denoted in the yellow line, the portfolio will also do that kind of pullback correspondingly. Due to the nature of the concentrated positions that I take in this portfolio, you can see that the swings tend to be pretty big or pretty wild. And I guess that's the price you pay for being concentrated, just volatility. So if you actually do have sharp eyes, in my previous slide, when I showed my portfolio breakdown, you would have took notice of a new position that I just added, which is to ticker symbol 3690, Meituan, and it's currently sitting at just under 1% of my portfolio exposure. And I've just bought it earlier this morning Singapore time. And I know that when I'm filming this video, the US market is probably in the pre-market, or it's not open yet, but the Hong Kong market is already open. So I'm working on my own local timing, which is 7 p.m. Singapore time. And just to show you the trade record, I've bought 100 shares of Meituan earlier this morning. And on top of that, I actually sold a put on Meituan at 140 strike. So some of you might be thinking, why am I suddenly talking about options? Don't worry, this is still an investing focused channel. But I guess just in the name of transparency, I just wanted to share my options position as well. I don't do it for the long term. And in fact, I probably wouldn't hold it all the way. If there is a significant enough profit in the next few days, I might actually just close it. But that's it. I think this is the trading part of the portfolio. I'm not going to share much. I just wanted to share that, yeah, I bought 100 shares of Meituan as a starter position, and I sold a put alongside it as well. Today alone, I believe Meituan was down roughly 4 to 6 or 7%, depending on the intraday of where you looked at. And in fact, earlier this year, a CNBC headline talking about Meituan, saying that they lost 82 billion in market cap amid rising competition, slowdown, and food delivery business. And you can see that from their most recent trough, which is around Feb of 2024, all the way to October of 2024, they close to 3.5 to 4x. And thereafter, from the highs of 217, they've basically traded back down to the $130, $140 range. Now, going on to what happened to Meituan today specifically, for those of you who are interested in getting access to real-time updates, you can go into Momo's app, search for the company that you're interested in, and click under the news section. And here you can see a list of resources that they provide in terms of the company's most recent development. And just today, Meituan down 4% with the headline, JD.com unlikely to gain meaningful food delivery market share from leading players. So if you can guess by now, why Meituan tanked so hard today was mainly due to two reasons. Firstly, it's because of JD.com's most recent initiative into the entire food delivery business, trying to snatch away their market share. And secondly, due to the crazy competition that they are intending to mount against Meituan, they are saying that restaurants that register with JD Takeaway before 1st of May will be exempted from commissions for the year. And by contrast, Meituan charges merchant a 7% fee. So clearly, it's the idea of competition. That's why Meituan suffered a pretty big drawdown today. So with this development in mind, I'm just going to walk you through my simple investment case for Meituan. So personally for myself, anecdotally, after my trip coming back from China late last year, I'm clearly very impressed with Meituan's development. And I used to actually hold a very negative biased view around the company, mainly with two main issues that I have with. Firstly, it's of course clearly because of competition. So prior to Meituan scaling, I believe that Tencent was the huge shareholder backing Meituan's growth. And I know that it's a highly competitive space. You have Alibaba in it as well. And then today you see that JD is coming in, and you have Trip.com that is also competing in terms of their hotel and leisure experiences booking. And of course, Pinduoduo competing on the grocery space. So I'll talk more about them in the later part of the video. But secondly as well, I do understand pre-crackdown, Meituan was basically squeezing a lot of their stakeholders. Long story short, they didn't provide with adequate insurance. They were also shortchanging a lot of the merchants, etc., etc. So there were quite a few horror stories coming out. But all these are from a third-party point of view. And after the tech crackdown, the government regulations came in, trying to protect and maintain the peace around these different stakeholders. And of course, my first-hand experience of using that so-called mini super app, not as super as Tencent, but super enough for me to be addicted as a consumer. That's why I really have this 180-degree shift in terms of mindset and how prevalent Meituan is in the entire Chinese tech ecosystem. So, and sometimes you really need to see it to believe it. And also, just an additional point, after Tencent pulling out of the partnership at end 2022, as they give out Meituan shares as a bonus sort of dividend to existing Tencent shareholder, Meituan still held up pretty well with more than 70% market share. And if you look at the growth of Meituan over the past 5 years, I think this is a pretty respectable tech company. And more importantly, given the slowdown of the entire Chinese economy, Meituan on the other hand, they are still growing at a respectable 20 to 30% growth rate. Although slowing down from the significant or crazy amount of growth in 2021. Meituan coming from a relatively smaller base, I think there is still pretty big penetration. So for myself, I think the thesis for Meituan is pretty simple. They've already achieved critical mass, and the early innings or the earlier part of the network and infrastructure building is hard to catch up, and they had the backing of Tencent to build up the moat that they already have. So they're in the middle of the holy trinity, managing the three different stakeholders. Firstly, of course, you have your fulfillment network, those people doing the delivery, your riders. You have the merchant base, the participating merchants, and last but not least, making sure that your customers are addicted onto your platform. So having the mind share of your consumers is equally important as well. And going into the details, my initial impression of Meituan was that they really relied very heavily onto the WeChat and Tencent ecosystem. But even after the divorce in terms of their partnership, they're still as competitive as ever. So they're adapting very aggressively to the evolving consumption trends. And as we know, the Chinese economy has not been performing very well, and people are not optimistic of the outlook of their jobs, and they all think towards trying to lower down their costs. That's why you see companies like Pinduoduo filling that void. Meituan, they started this community buy model, which is an exact copy of Pinduoduo, but more so for the F&B space with this idea of Pin Hao Fan, where everybody in the same community can kind of contribute to some sort of a group buying or bulk buying. So that's just one example. Secondly, I think they're also expanding and onboarding a lot of many of these services aggressively outside their food delivery, and they're expanding their arms and legs into many of the other under-penetrated markets. And right now, I believe that in terms of the penetration, it's still in the mid to high single digit. And that means that there's a huge tailwind or huge total addressable market as Meituan continue to scale up. And more importantly, they're not afraid of competition as well. In fact, they are going directly into taking on Pinduoduo's grocery market share. So if you take a look in terms of their earnings and monitor them over the past 2 years or so, you can really identify superb level of execution and operational efficiency. Later, I'm just going to share a few numbers. Margins are increasing, losses are reducing heavily in terms of some of their new initiatives and new developments. So I think it's just a A+ across the board. Big trends that Meituan is trying to ride on is really on penetration and the consumption trend into the recovery that we all look towards or hope for. And of course, the innate demand for convenience, especially when the wealthy class or the middle class continue expanding. And let's not forget, there is still a huge runway for growth if and only if you think that there is some sort of recovery heading towards our way and where the Chinese consumer will exercise the same amount of spending power in terms of some of these services. So you can talk in terms of food delivery, travel, experiences, hotel, dining, etc. You name it, I think Meituan is in it. So all things considered, I think Meituan's financials are moving all in the right direction with strong growth expected. I mean, comparatively speaking, you are still looking towards 12, 15, 18% growth in the next 3 to 5 years. So looking at top line revenue growth is one. If you do look towards their bottom line of cash flow from operations, they have recently turned from negative back to positive again in roughly late 2022. And you can see that the earnings are trending up with a twin engine. Firstly, of course, due to top line growth. And secondly, of course, the expansion in terms of their margins. So looking at it in totality, I think Meituan is a pretty interesting company here. So moving on to the antithesis of Meituan, because like all investment, there are risks involved. And first and foremost, of course, if you talk about Chinese tech or tech companies in general, you cannot run away from government regulations. So I think for myself, I think I've repeated umpteenth amount of times. I don't buy the entire idea that Chinese government is out to kill the tech companies. And there is still quite a lot of growth and a lot of penetration for them to reap the value and to reward shareholders in the longer term. I think second part is really on market competition. I believe that personally, healthy competition is good because it keeps everyone on their toes, but irrational competition is the bigger issue when they hit their bottom line again, because it's the race to the bottom and everybody is just expanding their balance sheet and their earnings just for the sake of growth. And Meituan has already underwent that process of trying to first build out their network and infrastructure. So if JD comes into the picture, who knows what's going to happen. So I believe that's probably one of the main reasons why investors will sell first and then think later. But I think a sub point that I want to add here is that actually Alibaba has been in this food delivery and delivery business for quite some time now with their platform. And given the current split in terms of market share, despite Alibaba's long-term commitment and investment into the space, Meituan still commands a majority of the stake at roughly 70-80%. And Alibaba is one with deep pockets. So I'm not too sure whether is it a strategic priority or why Alibaba is holding back in terms of going to the space. But at least for now, I think as a dominant player and as one of the most competitive ones, Meituan's appeal as a mini super app and their network effect is still underway. Barring the fact that there might be certain black swan events that might tilt into Alibaba or even JD's favor, at least in the short term, I don't think that's the case. And last but not least, of course, it's around the idea of consumer behavior. So I'm not too sure about yourself, but I do know that in terms of the ride-hailing business, at least based on where I'm at, there really is no loyalty to the platform. So for myself, if I'm going to a destination, the ride itself is a commodity. So I'll switch over to many of the different platforms to see who offer me the cheapest rate. And this consumer behavior might very well be carried over to the food delivery space or the travel or experience booking industry, where there's no loyalty to Meituan's platform and everybody is just comparing price because it becomes a commodity. But at least based on my current view and experience, I think Meituan as a mini super app and constantly parking themselves in the consumer mindshare and being very quick to adapt and introducing new initiatives really do help keep their consumers pretty hooked on the platform itself. But of course, never say never. But I think over the past 2 years, when Tencent checked themselves out and it was a 1v1 between Alibaba and Meituan, so Meituan is clearly still hanging on to the crown. So I'll leave it as that. Lastly, when we talk about valuations of Meituan today, they're currently trading at roughly 28 times PE. Their forward PE is between 18 to 24 times, depending on which analyst or which banks you're looking at. Their price to operating cash flow, roughly 17.8 times. EV to EBITDA at 22 times. So if you are using a DCF, trying to discount all future cash flow, it really depends on the margin percentage that you are including out into the next 5 years, because I personally do believe that they are currently not optimized in terms of their free cash flow margin. And secondly, what's the exit multiple that you're willing to tag onto this business? So I think 3 key factors to consider. Firstly, of course, is top line growth rate, still expected to grow quite strongly. Secondly, in terms of execution and efficiency gains, margins are trending in the right direction. A huge amount of tailwind and total addressable market that Meituan is positioned in. I think these 3 factors together, today, I won't say Meituan is necessarily extremely undervalued. I think when compared to their other Chinese tech counterparts, you can easily find a lot more undervalued names. But I think they're probably trading at right around near fair value today. And if you do buy into the story and the vision of where they're going to expand towards, I think this could potentially be a pretty good multi-bagger. I mean, of course, if they execute well. If not, I think that's generally how I look at the company and the valuations today. And like I said, it's a starter position. I'm buying and I'm monitoring. If they do continue going down, or in fact, if my CSP gets hit, I might continue adding to my position. So a simple conclusion to this entire episode, is this really the start of the real China bull market? I think your guess is as good as mine. But I think as the story start to develop, we will need to see numbers to back it up. So you can look at their subsequent earnings for estimation, and not just this upcoming 1 quarter, but more so looking out into the long term, the next 4 to 8 quarters, whether there's some sort of monetization and whether the story can continue running or not. So for myself, I think I always just focus on buying good and cheap and let the rest take care of itself. And there's a very interesting question that I've got from a friend recently. He's asking that what if we actually go into some sort of a global recession and there's a bear market hitting the US market? What's going to happen to the Chinese market? I think if it's a small pullback in the US market, I think China can continue running. However, if it's a black swan or if it's a large global recession sort of event, of course, the Chinese market will tank alongside the US market. But considering the state of the Chinese market today, even if it tanks alongside the US, I don't think they can go down another 50 or 80%, unlike the US that are clearly trading at their all-time high valuations. So with that in mind, feel free to leave in the comments below on what you think about Meituan, and I'll see you guys in the next video. But more importantly, and hopefully, I'll finally see you guys on the moon. Goodbye.